The following script was written, verified, and approved by compliance professionals at financial regulation courses. Welcome to the Finance Dictionary. Today, we are defining the front-end load, a critical regulatory concept in mutual fund distribution. We will examine its statutory evolution and impact on investor capital. A front-end load is a sales charge imposed at the time of purchase. It is calculated as a percentage of the total amount invested and is deducted immediately from the investor's initial contribution before the remaining funds are put to work in the fund's portfolio. This charge serves as the primary distribution cost mechanism, compensating broker-dealers and registered representatives for their sales efforts. Since the load is taken up front, the investment must overcome this immediate cost before generating a net positive return. Historically, the front-end load is recognized for its transparency. Unlike back-end loads or recurring 12b-1 fees, investors see the exact dollar amount deducted at the point of purchase, allowing for precise calculation of total distribution costs. Moving into the structural mechanics, the load is expressed as a percentage of the public offering price, or POP. This total price includes both the net asset value of the shares and the sales charge itself, which is a key technical distinction. For example, if an investor commits $10,000 to a fund with a 5% load, $500 represents the charge. Only $9,500 is actually invested. This creates an effective cost of 5.26% relative to the net investment. To manage these costs, the industry utilizes breakpoints. These are specific numeric triggers where the sales charge percentage decreases as the investment volume increases. Typical look-back windows and accumulation rules ensure that larger commitments receive more favorable pricing. A standard fund might charge 5% for purchases under $50,000, dropping to 4% or even 0% for institutional-level investments. Correct application of these thresholds is a fundamental operational requirement for registered representatives. Operationally, investors can reach these breakpoints through the right of accumulation or a letter of intent. These mechanisms ensure that dual-channel distribution remains equitable across all investor classes and physical boundaries of the fund family. The right of accumulation allows you to aggregate your existing holdings within a fund family with your current purchase. This means your total historical investment volume counts toward your current breakpoint, even if the new purchase alone is below the threshold. Furthermore, a letter of intent provides a 13-month window to fulfill a specific investment commitment. By signing an LOI, an investor qualifies for a reduced load rate on their very first purchase, provided they complete the total investment within the specified cycle. Disclosure delivery mechanics are critical. Regulation mandates that firms provide clear access to these rules. Failing to apply a qualifying breakpoint is a violation of fair dealing obligations and can lead to significant regulatory enforcement. Supervisory oversight is governed by FINRA Rule 2341. This rule establishes a strict jurisdictional ceiling, capping the maximum front-end load at 8.5% of the public offering price to prevent excessive distribution costs. Within a firm's written supervisory procedures, or WSPs, there must be controls to prevent breakpoint sales. This occurs when a representative recommends a purchase just below a threshold specifically to maximize their commission rather than the client's benefit. Audit readiness is maintained through rigorous books and records retention cycles. Regulatory access clauses ensure that examiners can verify that every breakpoint was disclosed and every load was calculated accurately across the firm's entire transactional history. Regulation best interest further mandates that broker-dealers must justify their share class recommendations. Recommending a front-end load Class A share when a lower-cost institutional class is available requires specific documentation to ensure the investor's best interest is prioritized. When comparing share classes, Class A shares with front-end loads are typically more cost-effective for long-term horizons exceeding 5 to 7 years. The upfront cost is offset by significantly lower ongoing 12b-1 fees compared to Class C shares. As you prepare for the SIE and Series 7 exams, remember these key takeaways. The POP is always the denominator, letters of intent cover 13 months, and the FINRA maximum load ceiling is strictly 8.5%. Mastering these technical sub-rules and statutory cross-references is essential for any regulatory expert. Stay committed to excellence in compliance. For more insights, visit financial regulation courses and the Finance Dictionary. Stay compliant.